We have finally reached the light at the end of the tunnel. Although a little delayed, we are ready for a very, very different year when it comes to real estate across the country, not just here in the GTHA, but also in Alberta and beyond. And what I wanted to do is I wanted to have this webinar in January so I could set the stage, give everyone the proper information when it comes to the real estate industry and what's happening with our markets, and kind of wade through the pool of misinformation that we have been swimming in. The one thing we do know is that the media tends to misinform us. Their goal is to capture headlines, and the way they do that is by sensationalizing one-line headers that grabs your attention, but really doesn't have any substance. And I was actually having a great conversation with someone earlier today, and I was basically discussing how don't take everything at first glance. Try to understand what is happening behind that catchphrase that you're seeing. And that's what we're going to attempt to do here today to give information. Knowledge is always power. So we have a lot to talk about. Sorry for the little bit of delay. I wanted to make sure everybody got on. We have hundreds of people that have signed up for this, the majority of which will be seeing the recorded version. We're going to try to do a little something different. We're going to try to break it down into segments, one for each topic discussed, so that if anyone wants to go back, they don't have to fast forward through the entire thing. I don't know if it's still called fast forwarding, but that's what it used to be from back in the day when we had cassette tapes. Okay, now everybody knows how old I am. But what is happening with the market? Well, over the second half of last year, we saw interest rates come down. They're actually down 1.75%. That is monumental. They will continue to go down as the forecast by all the big banks. That is the Bank of Canada prime rate, which affects variable rate mortgages. We also saw bond rates start to come down, and then they ticked up a little bit over the course of December into early January. There's some concern we would see interest rates go up again. I am on the side of the fence, which totally disagrees with that. Bond rates have started to come back down. And the thing about tariffs and their ever looming specter over us, which I will talk about shortly, if they impose tariffs, we're going to have to stimulate our economy. If they don't impose tariffs, we still have to stimulate our economy. So that's why rates are going to keep coming down. So if we go to the next slide, we'll give a brief breakdown of what we're going to discuss tonight. We're going to talk about the elephants in the room. For the last almost 3 years, we had the elephant of interest rates and inflation, and that was constantly ever present in every room. Now we have the threat of tariffs from our friend Donald J. Trump, the new president of the United States, who was sworn in at his inauguration yesterday. So we're going to talk about those tariffs, what it means for our economy, what it means for our real estate markets, and what it means for interest rates. We're going to talk about that. Then we're going to talk about the Greater Toronto Hamilton area real estate insights. We are going to tackle the other elephant in the room, which is the market crashing? Are prices going to fall down more? What is going to happen with supply? And see, here's the thing. Everybody likes to talk about sales and prices, but no one likes to think ahead. Everyone's thinking in the present. But when it comes to investing your money, you are looking for appreciation, not just tomorrow, but down the road. So what you need to do is you need to have the gift of foresight, the ability to forecast, predict, speculate what's going to happen from an educated stance, and that's what we will try to do for you. Then we're going to talk about Alberta, something that here at First Access Realty we have been promoting for the past couple of years. A lot of our clients have done very well there. They have been experiencing a boom, and we are going to talk a little bit about the sudden downturn in rental prices and increase in vacancy rate in Calgary. And I'm going to explain how that is not the sky is falling, but that is a temporary phenomenon that we have a lot of experience with here in a condo-centric city, and they're just starting to experience it now. Then we're going to do a bilateral comparison, Alberta, Ontario, pluses, minuses, where you should invest your hard-earned money for maximized return. And then we're going to talk about the jewel in the crown, the CMHC MIL Select Program, something that I personally have been focusing almost exclusively on for the past 6 months, and what I was introduced to almost a year ago this week. So we're going to talk about those things, and then I'm going to tell you about an in-person CMHC info session that we will be hosting next week. For those of you that attended our last one in October, we had over 80 people present. It was fantastic. The energy in the room was electric, and I believe it's going to be the same way and maybe even better next week. So without further ado and without wasting any more time, let's jump into tariffs. So Canada evades immediate Trump tariffs. Thank you to Danielle Smith, who, in my opinion, is the queen of Canadian politics at the moment. And I'm not taking a political stance. I'm just taking a stance based on her proactive approach and pro-democratic and diplomatic approach when it comes to our interactions and relationship with our largest trading partner down south. So Daniel Smith went down. Kevin O'Leary has been a big proponent of this. They've been discussing our economy and the future implications with the new president of the United States and his administration, as opposed to the other politicians in Canada who are sitting here and rattling their saber, which is really a paper straw, because we are a mere pimple on the behind of the United States, except for our energy. So Doug Ford, I actually like Doug Ford, but I do not know what his addiction to alcohol is. He's always talking about something at the LCBO, lowering beer prices, doing this. And now his latest stance is that he's going to pull American booze off our shelves at the LCBO. When in reality, we are a really small market for that. And as opposed to sitting here and I don't want to say anything bad about Justin Trudeau. He's really low-lying fruit, and I've actually taken a step back from attacking him about a year now because it's just too easy. But he all of a sudden decided to man up and be the Canadian bear and stand up to the Americans with this tough talk. Well, him and his administration have really set back international relations across the world for our country. And he is doing the same with like I said, our largest trading partner and a country that we're really seriously dependent on economically, security-wise, et cetera, et cetera. And I think he is taking the wrong approach. So is Doug Ford. And they're sitting there basically saying, we're going to stand up to you, as opposed to trying to find out what similarities and how our economies are intertwined. So Trump indicated 25% tariffs on Canada and Mexico. They could begin as early as February 1st. They were supposed to begin today, but he has delayed that. And he plans to propose 25% tariffs, 10% on global imports, 60% on Chinese goods. So it's not just us. But besides the tariffs that are going to be applied on China, us and Mexico seem to bear the second largest brunt of that effort and that negative thing. We have a 75% dependence on our exports going to the United States, making trade with them crucial. Here's the thing, and we don't hear about this. Trump and his administration has gone out on record and said they basically support us to the tune of $100 billion a year, and there's a huge trade deficit between America and Canada. That is true because we are a small market. So we are a very small market when it comes into the amount of goods that we can purchase, because our population is minuscule at like 41 million, regardless of how many people have come into the country the past couple of years. But here's the thing, and a lot of people don't know this. We actually have a trade surplus with the United States in that we buy more of their goods than they buy of ours if we exclude energy. So our major export to the United States is energy because they need it. I was listening to Danielle Smith yesterday, and she was actually giving the numbers. I believe the Americans need 31 million barrels of oil a day, or 21 million, something like that. And they can only produce 13, I believe it was. So they're a shortfall of 8 million barrels a day. Now, what better place to get that oil from is from a friend and ally. And because their refineries are already tooled to process our heavy crude, it is essential, because she said the only other countries they can get that type of oil from is Iran, Iraq, and who else was it? It was Iran, Iraq, and somebody else. But regardless, they weren't friendly per se in the eyes of diplomacy, whereas you have us right next door. So we can find a way to increase our oil production, sell more to Americans. And with the new government that is supposed to be coming in, according to the polls, if we get our pipelines and spread them out to both coasts, and we can get our oil and natural gas to Europe or oil and natural gas in Asia, that'll actually increase our price, because right now we have a lower price for our oil, not because we sell it at a discount, it's because we have an inability to get it out to open markets. And that's why our oil is selling at almost 15 to 20% less than comparable oil that is open to those markets. So our minister response, I don't even want to talk about the Liberal ministers because their time is limited and they're actually people that are just fill-ins. It's like, okay, who do we have left on the bench? We'll call him in for the last couple minutes of the game when it's already decided. But he cautioned that tariffs were not new, and they're always talking about this. Following the American motto, talk quietly and carry a big stick. They like to rattle it around, but I wouldn't really too much. Okay. Counter tariffs ready. Canada's preparing retaliatory tariffs, potentially worth billions of dollars, to respond to the threat. Seriously, we can't really compete on that scale, so we have to find common ground and use a diplomatic approach. Canada's Foreign Minister, Melanie Joly, again, another Liberal minister that I don't really want to talk too much about, emphasized ongoing efforts to demonstrate the mutual benefits of U.S.-Canada trade, worth $909 billion in 2022. Inaugural memo, Trump signed a memo directing federal agencies to assess impact of trade deals and illegal immigration. Border security. This is important. We have an open border, unguarded border. So the Americans are getting flooded by illegal immigration in the South. And they also basically have a border that goes unchecked coming in from the North. Now, the irony of this is 99.9% of the firearms used in crimes come up to Canada from the United States. They're legally brought here. But there's a lot of drugs that start off coming into Canada and then they go south. And that's what they're really worried about. And I'm for border security. I am for, policing as it should be. So I think this is not a bad thing for us. And an example of how we underfund these type of agencies is comparable how we only pay 1/4 of what we should be paying into NATO. And I think it's about time we start paying our fair share. That also has to do with the way we are perceived on the worldwide stage when it comes to how respected we are. And we've really taken a hit respect-wise internationally with this past administration, and hopefully they can get out as soon as possible. Now, economic concerns. Economist warns tariffs could raise prices for U.S. consumers and provoke retaliatory actions that hurt business. Here's the thing. Tariffs in itself are inflationary because they increase the cost of goods. But then they have a reverse effect and they become deflationary because as prices increase, people spend less and then deflation kicks in. And once we remove the current inflation rate, I believe it came in at 1.8 for December. Once we remove housing, okay, then actually it is almost deflationary. So we're on track for deflation. And the last thing we need is any type of measures to further accelerate that, because those of you who have watched my previous videos in the past, you'll know that deflation is inflation's older, angrier brother, and we do not want to fight that guy. Everyone has seen this chart for me over and over again, and the reason I like to keep showing it is because if there is any talk about interest rates going up, what we need to do is look at our historical data. So the reason I have always liked to study history and religion is that it shows us the past because the past repeats itself, and religion and psychology kind of tells us how people think. So unfortunately, we have a very, very short-term memory as a society and humans in general, and we forget what happened years ago, so we don't really know what's going to happen in the future. Every time the BOC in the past 30 years has raised interest rates, okay, they have dropped them quicker than they raised them. And here we see, circle with the big 5 drops, we've had 5 rate drops in a very short amount of time, and we predict, us and other economists predict accelerated rate drops in the months to follow. I believe this will have a great effect on our real estate market, as a lot of people are sitting on the sidelines and been waiting to see when the bottom falls out to get back into the market. Economists predict inflation slowed further to December 1.7. It was actually 1.8. I do not believe the GST tax holiday had absolutely nothing to do with it. It was extremely complicated, didn't apply to everything. A lot of businesses didn't even apply because they didn't know what they could apply it to, and it wasn't worth the cost of actually reprogramming their POS systems, from my understanding. I think that was another ridiculous attempt just basically to get a couple more votes in the next election. Slower inflation could prompt Bank of Canada to continue interest rate cuts, guaranteed. BMO expects CPI at 1.8. That's what it was. Anticipates slight rise 2% due to higher energy and food prices. Gas is going to continue to come down, but historically, it goes up a little bit in the winter months. Once we have an end to the conflict in the Middle East, which is on the horizon, we're going to see gas prices start to come down a little bit. We also have a predicted end of the conflict in the Russian-Ukraine war. Donald Trump kind of has that effect on people when he comes into power. Okay, that'll also take the pressure off oil and gas prices as there's less chance of Russian refineries getting bombed. And OPEC already has scheduled a drop in production as they forecast the demand for oil will continue to stay sluggish. All those things will keep gas prices lower, and lower gas prices mean lower inflation. And I want to remind everybody of one thing. When the Bank of Canada slashed interest rates at the start of COVID, it was not COVID related. It was because oil prices tanked. And inflation has a direct correlation to oil prices. Everything is governed by the price of oil. RBC and BMO foresee the Bank of Canada cutting rates multiple times in 25, despite potential tariff impact. Here is the thing. Like I said before, if the tariffs come in, we may see an initial bump in inflation slightly. That's quickly going to reverse, and then we're going to see deflation set in. And this is not just me saying this, smarter people than me share this stance, because that is what is going to happen. But remember, if Donald Trump implements these tariffs, they will not just hurt us, they will hurt their own people. They are the largest economy in the world, and they're the largest importer in the world. And they will be importing things at a much more expensive price. GTHA market update. Now, everybody's heard what's been going on the grid. No, you can go to the next slide, Cal. Everybody's heard what has been going on the GTHA, okay? I'm still not used to saying HA, but it's really, we're going to see an amalgamation, a connection of everywhere from Durham all the way to Hamilton. And what we should have, and this is just my thinking, it is that it is insane that we do not have a high-speed rail network that connects Montreal basically to Hamilton, Niagara, and also to London. I do not know how we do not have a high-speed rail network. Imagine hopping on a train and be able to get to Montreal in a couple hours. And this is quite possible. It's quite possible. There's a train in China that just got approved. You could basically get there in less than an hour. Okay. This would really take a lot of pressure off house prices, because the only place that you can build actual detached, semi-detached, traditional low-rise housing is in the middle of absolutely nowhere, because there's no land where people want to live. So it's in the boonies, per se, out in the suburbs. And if we had high-speed rail networks, we could build out further where land is less expensive, less density. We could increase the density there, take less pressure off the city, also decrease the congestion on our roads, because it would be more convenient to take a train because you would get there faster, and it would just help everybody. But I don't know, we are giving money everywhere else but on ourselves here. And I will not get into that. But let's talk about stats and what has happened. Sales and listing. Home sales decreased by 2.6% in 2024 to 67,000, while new listings rose by 16.4%. So what that means is there was a disproportionate increase between the number of listings and the number of sales. Again, this is not surprising. Like I said, a lot of people are still sitting on the sidelines, and that is affecting sales volume. Another thing that it affects is also rental rates. So we saw rental rates actually come down in the GTHA. And in my professional opinion, and discussing with some of my colleagues, that is another byproduct of people waiting on the sidelines. And let me put it into perspective. Think of it this way. If you aren't sure if you're going to buy or rent, you don't want to get into a new lease and be on the hook for an additional year if you think the prices are going to drop and rates are going to drop and it'll be the ideal time in your lifetime to get into the real estate market. So you'd sit put. And when you sit put, the new rentals don't get absorbed as fast. But we'll get into that later too. Price trends. Average price drops slightly 0.8%, negligible, to 1,117,600, with condo prices seeing the largest declines. We saw drops in condo prices averaging around 4 to 6%, depending on the area. And although the media loves to jump all over this, I will like to send out a point and hammer it through. The last 18 months was the first time we saw a drop in condo prices across the board in a decade. So for 8.5 years, condos were continuously increasing, and they dropped for a year and a half out of 10. I think that's the performance of a winner. Everybody has a bad season, and it's how they bounce back, and I'm a firm believer, and we'll talk more about that later. Buying power. Higher interest rate limited sales, obviously, but Bank of Canada rate cuts in the second half of 2024 for added relief, improved buying negotiating power, especially in condos. And we would have had a busier market right now if our federal government hadn't soured relationships so bad with the Trump administration down south. Okay. And that's what I'm really going to push, is that the threat of tariffs is a specter hovering over a lot of people right now and creating a new sense of uncertainty. Before we had inflation and we had interest rates. Now we have interest rates and inflation. Inflation's tanking. Interest rates are coming down. Gas prices are going to come down, which means rates are going to come down from another factor even more. And then once we figure out what's going on with these tariffs, are they going to be implemented? If they're not going to be implemented, what's the extent? I really think the market's going to pick up. Market segment, single detached homes increased while condo sales declined. Yes, there's another reason I'm going to talk about that too. First-time buyers remain cautious, impacting cargo market more. Entry-level product, those people are scared to make the plunge. Outlook, further rate cuts and prices below historic peaks may improve market conditions in 25. Yes, I fully believe the market will improve this year. I also see we're going to see a rally of condos in the second half of the year. And the reasons behind that has a lot to do with the amount of product that was delivered last year. Next slide. Remember earlier how I mentioned to be a good investor, to make money investing. You can't just think of what is happening today. You need to see what has happened in the past, and then you need to prepare and forecast what's happening in the future, because your money, your wealth is going to grow in the future. It's not going to grow today. So what we have here is we see how little new construction sales happen in 2024. We sold less than 5,000 units. In comparison to the peak in 2021, where we sold over 30, we did the same in 2017. We had some fantastic years. And our number of sales right now is down around 1996. Why did they start to pick up in 96? They started to pick up 96 because the 90s were the first decade where we were actually overbuilt. We had more product supply than demand. And then over the course of the decade, that started to turn. And then once it turned and there was a lack of supply starting to be created, that's when we saw sales, new construction sales start to pick up. And that's really what led us to the boom and the peaks that we see here on this chart. Now, what happened last year was we had a record number of completions, 30,000, okay? That's a 24% increase from 23 and a 61% increase of the 10-year average, okay? With another 30 scheduled for 25. So think about it this way. We had the most condos ever delivered, and we had the highest rates we've seen in ages. So we had the least amount of buyers ready to jump in with the most product delivered, with the most inventory. And that's what caused the drop. And what we really saw is we saw about a 10% plus drop across the board. And I know that for my personal portfolio, maybe a little more, maybe 15, okay? But here's the thing when it comes to these investor products. is once the wave of investors come back in, they enter like a tsunami. Okay, because we have a herd mentality in the population. When one person does it, a lot of people do it because they're all doing it for the same factors. And that's when you see a really big, quick bounce back with the investment sector. Okay, so what I think, it usually takes about 6 months for a condo building to be absorbed by the rental pool. Because if you have 300 units come to market all within a 30, 60-day span, they don't all get rented out right away. You need to get absorbed, and that takes about 6 to 8 months. So I believe by the second half, of this year that we're in, we're going to see condo sales start to pick up. And what I do believe, and we can see to the next slide. Okay. I think this is a phenomenon that's more GTHA focused. And when it comes to Alberta and other parts of the country, it's a little bit different. But we did see how the extent of this, but we did see housing start slow across the country about 16.9% last year. And that's basically because the interest rates and the inflation. And now that interest rates come down, expect that to start picking up with a lot of multi-res, etc. So Canada's housing starts lagged in 2024, especially in major cities. Canada's housing starts showed a modest 2% increase in 2024, reaching 254,000 units, driven by high rental construction in Alberta, Quebec, and Atlantic provinces. However, the sixth largest city where demand is the highest saw a 3% decline. And that's really what we need to pay attention to. So, because we're investing in these larger cities, for those of you that actually think outside the box and aren't too concerned about being able to actually touch your unit on a daily basis, that's really where we've been pushing, because there are two markets that are still doing exceptionally well. This drop was largely due to a weak multi-unit start in Vancouver, Toronto, and Ottawa, where pre-construction condo sales were abysmally low. Okay. In contrast, cities like Calgary, Edmonton, Montreal saw strong multi-unit rental construction, and that's basically condos and apartment buildings, etc. Okay. Despite the overall rise, Canada's urban centers still face a significant shortfall in housing supply, hindering efforts to restore affordability. So here's the thing. Our housing shortfall has not disappeared. We didn't solve it by bringing to market 30, it might be closer to 35,000 units in the GTHA last year. We didn't solve it. We need about 60,000 to balance supply demand. And it's hard to comprehend that when you saw prices drop. But the reality is that if people are not deciding to move, not deciding to buy, not deciding to enter the market at this time, it does and possibly can lower prices even though there is a shortage. And what we're really going to see is we're going to see how much vacancy we really have, how prices are doing once the market picks up. Now, there's been a lot of talk about immigration and what's going to happen with that. And although they're going to lower the numbers, I believe that the people are not going to be allowed, the people that are not going to be allowed to stay aren't really the people that are affecting our housing market as a whole. So what we see here on this graph, because we have the beautiful graph, is we see housing starts and we see how they've dropped, with a slight uptick in the last quarter, in the third quarter of 24, but I don't really like looking at things by quarter because it's better to have a year view. Next slide, please. This is my favorite slide of every webinar I've ever done, because this right here should be circular like a sphere, and it should be made of crystal, because this is the crystal ball to the future of real estate prices in the Greater Toronto Area. How? Why? Can I make those claims? I definitely can. And I'll explain to you why. What we see is on the left side is amount of units that come to market. And on the bottom of the graph, okay, on the x-axis, I believe that's called, I can't really remember, there's an X and a Y, we see years. And we also can accurately predict what will be delivered in the future. And how can we do that? Well, we can do that is because we live in a place where it takes 3 to 5 years to build a condo building. There are places in the world where they can be built in less than a year, but unfortunately, we are not them. Okay, and we don't need to remind who those people are, but they can build a hospital in a weekend. But we can't. We can't even build a subway in a decade. And that is another personal conversation I will have with anybody, but I'm not going to be recorded about it. But here's the facts. Because it takes mostly 4 to 6 years to build a condo building from start to finish, sales to keys in hand, we know right now in 2025 what's going to come to market in 2029. We know this because if shovels haven't gone in the ground, it's not going to be ready. So what we see here is we saw the greatest number of forecasted units that were supposed to come. This was actually created last summer, so we didn't have a completion, but we were supposed to have 50,000 units last year. That got a little delayed, so we came around 35,000. We're going to have around 30,000 in 2025 this year. Remember what was that magic number to balance supply and demand? It was 60. We are still 50% of demand, but this is where it gets interesting. And if you're an investor, you want to buy something that is going to be in short supply and high demand in the future. That's how you can guarantee your price increases. High demand, low supply means an increase in price. This is economics 101. Now, in 2025, we're 28,000 units to market. We need 60. We're short 32. Say that number is about 35 because we had some delays. We're short 25. But this is where it gets into 2026. 12 short months from now, we are only going to deliver 13,000 units that year. So we are short close to 75% of what we need. And if you think that is bad and the sky is falling, get ready for apocalyptic numbers. In 2027, we are just going to have 5% of what the forecasted demand is. 5%. We're 95% short of what we need. It gets worse. 1,000 units are going to be built in 2028 and another 1,000 in 2029. That is why, my friends, that there are many out there that are forecasting that GTA home prices are going to double by 2030. When I tell people this, they look at me the way they used to look at me when I said that government takes close to 25% of your purchase price when you buy new housing in Ontario. And it wasn't up until 12 months or so ago that this actually became mainstream news. But it's always been happening. Just like that, I am here first giving you breaking news. This is Jojo Chinto's CP24 stuff, telling you that in the next few years, there is going to be a housing catastrophe in the GTHA where people will not be able to find a place to live. And it has to do with one thing. We do not have enough things under construction. And why not? Because we did not sell anything in the last 2 years. And if people like me don't sell something that's to be built, it can't be built because it cannot get financed. And without financing, nothing's going to happen. So save this, screenshot this, remember this. This is one of the most important things I have ever shared with everybody because this is going to tell us what is going to happen to prices in the very near future, and it is looking good for housing affordability. Imagine 1,000 units coming to market, 1,000 for one of the largest cities in North America. With zero immigration, this would be a massive problem. We are still the most people per volume immigrant and interprovincial receiving city in the country. We're the fastest growing metropolis in North America. And we are only going to have 1,000 new units. Remember that. This is happening. This is coming. And that's why I say the best time to invest is now. And we'll talk about that after. Now that I've told everybody what is happening with the GTHA, I'm going to talk about a couple projects in a couple areas. And yes, prices are depressed. And yes, there's an increase in vacancy rating. And yes, rental rates have even come down. Okay, and real estate is not day trading in the stock market where you buy, sell, buy, sell, buy, sell. You buy when prices are low and you sell when prices are high. And real estate is cyclical. We are at the bottom of the real estate cycle, and we have time to go up. You are buying at the lowest price. And two examples of this is I'm going to talk about a project called Artform where we sold a lot of units, which is in occupancy and is actually closed. And at this project, we are selling the remaining units. There's a handful of them at or below resale prices in the area. So you're getting a brand new unit with no development charges, locker parking included, okay? Part of a future master plan community, steps from the Cooksville Transit Hub. So you're going to have that HRT that goes up and down your Ontario, all the way from the lake to Brampton, and all for the price of resale. This would not be offered in the hot market. So if you have anybody or are anyone, sorry, I got to fix my chair, or are anyone that is looking for something or thinking about moving, why buy something old when you can have something new? Shiny's always better. So think about that. Steps to square one, very close. Prices in the 800s per square foot, just like a resale transaction, but it's brand new, parking and locker included. Reach out to us. I think this is a spectacular opportunity. Now, shifting to the other side of the metropolis known as Toronto, we're going to Durham. And Pickering City Centre being built by Centre Court Development, one of the big boys on the block, one of the only developers to offer no interim occupancy. You go right to final closing. One of the only developers to build everything on time, which is massive. Okay. They are building right next to the Pickering Town Center. Pickering Town Center is already getting an elevated, higher level caliber of stores coming in because of this. They're scheduled to build 4 towers right next door, all 45, 50 stories. Because of our relationship with Centre Court, we have a special, unique price for everyone. We have a lot of leeway, and they are already at 82% sold. So they have given us and our team, so reach out to your realtors, okay? Always reach out to your realtors to get in contact with me. We can actually go in there and negotiate a better deal than you ever thought you could imagine. I'm telling you. We can negotiate a better deal. They advertise 25K off remaining inventory. I'm telling you, if we go in there, I can do way better than that. Way better than that. I signed an NDA, not allowed to tell you exactly how much leeway I have, but I'm telling you, I have a good amount of leeway to guaranteed make you happy and give you the best deal you thought you could never have. And this is a Pickering City Center town, and this project is not having a problem selling. It's over 80%. It's hit its financing quota. It's going to be built. Okay, so reach out to us. And if you don't want to be in something that's so congested, so dense, populated, we have a great ulterior option to that as well. So reach out to your realtors. They'll get in contact with me, and I'll help everybody out. And I have 2 great projects right here in the GTHA, buying at the most opportune time for our investors and our end users alike, where prices are the lowest, rates are on a downward cycle, downward trend, and you know we're at the bottom of the real estate cycle, knowing that we have 5 to 7 years historically and empirically of growth in our future. My second home and the place I love and the province with the best premier in Canada. Okay, Alberta market update. Isn't that a nice skyline? The skyline's even better than that, and it's really, you need to visit. It's not the place people would think stereotypically in their mind. They have a great skyline that's popped up over the last decade, really. Okay, let's talk about Alberta. Migration. Some 22,000, almost 23,000 people moved to Alberta from all over the provinces in the 3rd quarter of 2024. That's down 17.2% from a year before. Okay. If that's down just under 4,000 people, imagine how many people were coming before that. And this is how Alberta really works. Alberta booms recently started to boom because Vancouver and Toronto were getting too damn expensive. So people started to go to Alberta because Alberta was booming. And those of you that don't understand what they've done to their economy, I'm not going to get into it right now, but they're not oil dependent like they used to be. In the past, it's only 25% of their economy, where it used to be 75. They're a big tech hub. They're very pro-business, very, very friendly to investment. And they've really got the perfect formula out there, and they're growing and they're drawing in people from other parts of the country. But as Toronto and Vancouver were getting really, really expensive for a while there, people started going there and realizing, it's really nice to live here. And then they started enticing foreign companies to come in, reworking their energy sector, big tech hub. And we saw 22,000 people come in the third quarter. Now, 11,000, 12,000 people left the province from elsewhere in Canada in the third quarter, increase of 2.9% in the same period. The result was a net gain of 11,000 people in Alberta in just one quarter. So you had 11,000 people coming to the province. They were almost exclusively going between Edmonton and Calgary, with Calgary leading the way. And the majority of the people coming here, as you can see on the chart, are either from BC or Ontario, okay? And that is really where they're getting their population from. We are losing, they are gaining. And it's going to slow down a little bit in the next couple, and really the next year, as prices kind of balance out here in BC. But once they start upticking, and then you see the skyrocket in 27, okay, when prices start to skyrocket again because of what I showed you in the previous charts, there's going to be another resurgence, a new cycle of extreme migration to the province of Alberta. And that's kind of when your product will be ready and delivered when you're investing with us. And that's why I really like it. The seat's driving me crazy. Sorry. Next slide. Okay. We're looking at total net on migration, Alberta, and then we can see the years, and then we can see from about 21 onward, that's when we see the boom. So that's when their 10-year plan finished implementation, and they really started pushing and becoming a mainstay and an attraction point, not only for immigration from other provinces, but also international immigration. We can see here where they were getting close to over 40,000 people, which was huge. Next slide. So, province of Alberta monthly statistics. Sales of detached houses in December rose 2.8% year over year. That's just for the month of December. They went up 3.7 for almost 3%. Listings down 6.8%. Inventory fell 11%. So as prices rose, inventory fell. So the opposite of what's happening in Toronto. Sales to new listing ratio increased to 105. So there were 100% more sales than there were listings. Average price was 8% year over year. Isn't that big? They had an 8% gain across the board in 24. Depending on property type, some were up as high as 12%. 2.81 months of supply, down 14% year over year. And the tightest markets with less than 2% supply were the places slightly outside, but they were smaller. And they're growing because Calgary and Edmonton starting to get expensive. So it's kind of a similar effect with sub-markets out there. But again, we're not investing there because they're more volatile. They're not developed yet. They haven't stabilized, okay? One of my friends, Jamie, caught the Jojo Chinto. Marvin caught that one too, for sure. Okay. Strongest price growth, Grand Prairie, 24%, Red Deer. But here we go, Calgary, 13%. So if you're looking at price growth across the board, because the other two are more volatile, Calgary is more stable, and that's what we're going to focus on, and that's why we invest there. So when we look at all these stats, basically to summarize them, and we're going to send this out to everybody, and again, it'll be broken down so you can look at it for yourselves. But what's really happening in Calgary, Edmonton, and Alberta in general, is we're seeing growth when we were seeing drops and loss everywhere else. So it is essentially the opposite effect of what we were seeing here in BC. So what we think of when we think of real estate markets in Canada, we think Toronto, we think Vancouver, okay? And what I've really tried to push the last couple of years with my time out there, with my experience out there, with my investments there, and now with my CHC and the big move that my agents and my friends, my colleagues and myself have been doing in that field, is that we really see that something special is happening out there. And it's a great time for you guys to capitalize on as investors and really to get in. And what, in the next slide, we'll start getting into some more information about it. This is kind of the highlight. So Alberta's home to over 3,000 tech companies. And they fast track, sorry, business applications, building permits, et cetera, out there and funding. And Kevin O'Leary came out and said he's thinking of doing a $7 billion um, data center just outside of Edmonton, I believe, kind of in between Calgary, Edmonton. And this is kind of what's happening out there. So earlier I mentioned, don't think of Alberta as just oil and cowboys and the stampede. This is really where you're seeing their growth with startups, with AI, companies that specialize in tech. Okay, almost like a Silicon Valley of the West. That's what's happening out there. And you need a lot of energy to fuel these data centers, and they have it in abundance. And that's really, really going to be the driving factor in a lot of this moving forward. And Edmonton is booming. Calgary was booming. Calgary saw a slight increase in their vacancy rate and their first drop in their rental rates. And there's a reason for that. And the people in Calgary don't understand it because they're new to this. They're babies in the world of high density cities and so forth. And what we have experienced here, and those of us that study condo trends, is when a new building is delivered, the majority of the people get their keys within 2 to 3 months. Okay. If, like I said earlier, if we have 300 units and it takes about 6 to 8 months for those rental units to get absorbed by the demand in the area. Calgary had over 19,000 new units delivered to market last year. That's a 22% increase from 2023. So they had 22% more than what they're used to being delivered. Okay. And they're having a similar situation as what happened in Toronto, is that for the first time they built so much. That's going to get absorbed. Not as much is going to get delivered next year, and prices are going to come back up. And what's going to happen a couple of years down the road, we're going to get a second tsunami of interprovincial migration as Toronto and Vancouver start to get expensive again. So when it comes to investing in Alberta, you're buying today, but it'll be ready in 2, 3, 4 years. Think about that and how that plays out. It is actually time perfect for you to maximize the returns on your investment. So let's talk about their investments. I need a drink. That was a long one. Alberta is shifting from oil and gas hub to a growing tech destination with over 3,000 tech companies. Investment grows $707 million raised across 86 deals in 23. Strong deal flow in 24 with companies like Benevity, Jobber, and Neo Financial attracting major investors, General Atlantic, Valor Ventures. AI leadership, University of Alberta and AMI leading AI research and commercialization. 30 million invested by the provincial government in AI innovation in 22, and all startups like Geological AI, PayShepherd, and Retinal Logic are closing deals and moving to the province. Like I said, major tech hub is forming in that province, and they have the energy to be able to fuel and feed those technical monsters and get them going. And it's going to be a place that's going to really focus on this moving forward. Next slide. I hate this chair. Alberta's data center advantage, a growing hotspot for critical digital infrastructure. Guys, I just want to point out, I don't really read this and prepare for this. I'm taking information that I learn and knowledge that I gain just in my conversations and my day-to-day research. And then I'm actually shooting from the hip and from the heart when I talk about this. And a lot of the stuff that I say that ties into the next slide, this is because I believe in it and I invest because of it. So don't think it's scripted. We just have this to help put something visual. And I want you guys to know that I really do believe in this. And anytime anybody wants to have a call up their agent, create a three-way, get a Zoom going, and I'll love to have you guys pick my brain because I want everybody to make money. Alberta's data center advantage, a growing hotspot for critical digital infrastructure. Alberta is becoming a key hub for AI and data center development, as we talked about, driven by federal support and the provincial AI data center strategy. The demand for data centers is set to triple by 2030, presenting Alberta with a $75 to $100 billion opportunity. That is a lot of money. And remember, Alberta doesn't receive equalization payments. The rest of the country does. So they actually will get $100 billion more. Okay, competitive advantages, power, abundant, reliable natural gas and renewable energy, talked about that. Big push into renewable energy out there. Climate and water, cold climate efficient water use reduce costs. AI centers and their servers would rather be in cold climates. Food for thought. Low land and energy costs, favorable exchange rate, and competitive taxes. They would also like to be somewhere dry. And technically, Alberta is a desert. Okay, regulatory modernization for strategic actions, streamlining development process, AI data center, concierge program, easing pathways for new entrants, partnership for the Indigenous community. That's not really something that should affect our investments. Not that I'm against it. It's not large enough to move the investment one way or another. Collaboration, partnering the local municipalities, companies, and institutions to boost AI capacity. Rental market see vacancy rate for Calgary. This is where we saw, okay, we saw high vacancy in the early 2000s, and then we saw the move to Alberta movement start to form. And we see a serious drop. We were up over 6%. That was during COVID, okay? And then it came and it tanked. And we were at 1% for 23, 24. The vacancy rate actually is up around 4 now, and that is only because of how many units were delivered. They have not been absorbed. Once the rental pool absorbs the new housing, that'll drop back down in my forecast to below 2%, closer to about 1.5%. And then we see a slight increase in 26 as more units are delivered and need to get absorbed. But then we're going to see a massive shortfall of housing once the second tsunami of migrants interprovincially come. And those are my forecasts based on my experience and my research. Edmonton. I have not talked a lot about Edmonton. And the reason I have not talked a lot about Edmonton is we are mostly condo-focused investors, although we do some low-rise. But what we have been selling in Edmonton is the CMHC MLI. And we have been selling real CMHC MLI. For those of you that don't know what it is, bear with us. You'll hear about it a little bit after. But for those of you that do know, and if you don't, you should, CMHC MLI was originally designed to be able to provide housing in the actual cities, multi-unit housing. Think about all the bungalows that used to get torn down in the GTA, and then we would build these mini mansions on them, okay? And there would be like sore thumbs sticking out everywhere. What they started doing in Alberta was they would tear them down and they would squeeze as many townhouses as possible with a lower and upper suite, and they would create housing. Brilliant, isn't it? And here people are trying to do it because they've allowed 4 units, and neighborhoods are up in arms, and NIMBYism is all back. With the slowdown in condos, NIMBYism disappear. That stands for not in my backyard. And now it's back, and everybody loves the idea, but in another neighborhood. Sound familiar? Okay. It's how great people. I just don't want them living next to me. Remember that? I used to experience being Greek in a predominantly Anglo neighborhood. And it's the same kind of thing. It's the same kind of mindset, just shifted paradigms into something else. But in Edmonton and Calgary, that's where the CMHC is happening. So because we're selling so much in CMHC in Edmonton, I wanted to talk to you guys about it. Edmonton's vacancy rating right now is lower than Calgary's. It's the lowest in the country at about, for a major urban center, about 1.4 million, it's about 1.2%. They have some of the highest increases in year-over-year prices and rental rates across the country. Edmonton is technically booming. And because Edmonton doesn't build so many condos, they don't have the capacity to deliver so many units per year. So there is not a flood of new housing as they experienced with Calgary that has condo buildings, okay, has more of them. So Edmonton is still very, very, very low vacancy rating. So people that are buying these CMHC multi-units in Edmonton are renting out almost immediately for top dollar because there's no competition at all. Okay, so let's talk about it. Vacancy rate for purpose-built rentals in Edmonton declined from 4.3 to 2.4 in 2023. These are purpose-built rentals. They're not things that people bought and then decided to rent. These were designed to be rentals. That is the lowest vacancy rate in almost a decade. Rental demand was fueled by stronger demographic and economic growth. Strong rent growth and declining vacancy rates raised affordability challenges, especially for lower income households. We know some people that live in Edmonton, and they said it is near impossible to find a rental. The role of the secondary rental market expanded as more condominium apartments were offered as longer-term rentals and similar rents to purpose-built rental apartments. But that is a new trend about 3-4 years behind Calgary. That was about 5 years behind Toronto. So now you can see the progression. And remember how I said where Toronto was like a mini New York, Calgary was like a mini Toronto, et cetera, and Edmonton's behind them. Next slide. Growth in rental demand resulted in a lower vacancy rent and higher rate growth. So what we can see here is vacancy rate and average rent growth. And as the vacancy rate dropped, the rent growth increased. So there's an inverse relationship between the two. This is common sense, but we have to outline it for everybody. So as vacancy rate drops and less product is available to be rented, the product that is available rents out for more money, similar to if we do not build enough housing and the demand keeps increasing. And this is still happening in Edmonton because, again, food for thought, point to take home, they have not delivered as much new product as Calgary did, yet they are growing at almost a similar rate. Edmonton hits record population growth. Let's see the growth. Where do we have Edmonton on our chart? Edmonton here in 2014 grew at about a rate of 3%. In 2019, it slowed down right before COVID at a rate of 2%, and now it has doubled that at over 4%. Calgary grew at 6%, and Toronto grew at 4%. So I've been telling everybody, percentage-wise, the fastest growing city in the country is Calgary. The fourth is Edmonton. And Toronto, percentage-wise, is way down at about 8%. Now, if we base it on people, actual numbers, it's Toronto because we're almost at 5 million people. But when it comes to percentage and the ability for an area to absorb the new migrants that are coming there, the density to absorb it, Calgary and Edmonton are having a very tough time. And when they're having a tough time with that, we as an investor have a great opportunity to invest and make money. We have a couple projects I want to talk about. And one is in the suburbs. It's a low-rise suburb condo, which is about 4 stories. And the other one is a 30-plus story tower in the heart of the city, right next to the IBM building on the other side of the block where I personally invested by the same developer because we only work with the best out there, okay? And it's next to the Google think tank offices where they have a bunch of high-tech companies all in one building, kind of like their version of a mini KW, okay? So Highgate Huxley, prices starting in the 300s. That's not a typo. Rental guarantees, free parking and locker options, free property management, everything's being taken care of. So when they started getting the wave of Toronto and Vancouver investors, everything kind of shifted to cater towards us. And because of that, you, the out-of-province investor, have nothing to worry about. And if you talk to your agent and get an information, you can come discuss this with us on a Zoom or in person, or we are having a sales event end of February where we're going to go over this and do a great presentation in person and talk just about Alberta investing. But in the meantime, if you want to grab some great units and your price point's a little bit lower, think about buying a 2-bedroom unit for $40,000 all in for your deposit. That's true. 10%, $40,000. We have 2 bedrooms in the suburbs at Highgate Huxley in the 400s. At Lincoln Tower, that's slightly different. This is going to be the most luxurious condo building in the city of Calgary. And the one thing Calgary doesn't have, new luxury buildings. The luxury condos that are available, and they do have $1 million condos, are 20, 25 years old. Nothing new. And because of that, Imperia and the sister building Lincoln, and I bought an Imperia, are going to be capitalizing on that niche market. There is always a market for the best. And these two buildings will corner that market and will demand their own level of pricing. So although they are slightly more expensive with two bedrooms than the 600, I guarantee you that these will be making fantastic returns and experience incredible appreciation, is because they're a limited niche product that will be in demand, because any of you that go to visit Calgary, you'll see that there is a lot of money there. Okay. Again, free parking locker, rental guarantees, property management, and all the product you see us promoting in Calgary is built by Truman Homes, Calgary's #1 home builder since the 80s, 4 decades of construction, family run business. And I'm lucky and proud to be one of 7 people that's a direct representative. And through your agents, you'll be able to capitalize on those relationships and get a fantastic deal for yourself. And the majority of the people watching here either have purchased or know somebody that has purchased. So if you haven't, reach out to us. When we talk about Calgary, you can just switch that to Edmonton, because rental rules and regulations are provincial. So what is good for Calgary is good for Edmonton. So this is going to be a Toronto, Calgary / Edmonton comparison bilaterally. Toronto, much higher prices. Calgary, half prices or less, almost half. Edmonton is slightly below Calgary. 20% in Ontario, 10% deposit for pre-construction in Alberta. Various fees and taxes are associated here, including land transfer taxes. None of that in Alberta. $50,000 to $60,000 minimum closing costs on average here in Toronto. That doesn't happen in Calgary or Edmonton. Occupancy period might take up to several months. We have a lot of guaranteed rent offers, minimal closing costs, usually just legals, and quick occupancy periods. There's no real occupancy period. It's closing, then occupancy combined, but that is a little complicated, and I can discuss that with you and your agent at another time. Next. Now we switch sides of the screen. There are absolutely no rent controls in Alberta. Toronto is extremely rent controlled and one of the most regulated places to be a landlord in North America and the world, heavily in favor towards the tenants. We do not have much say. I like to joke, and I actually should say it with tears in my eyes, but when you take on a tenant, you actually adopt them and they become your responsibility. No automatic contract extension here. They're yours until they want to leave. Easy and quick eviction process here. You can't evict. Let's call it like it is. They leave when they want. Legal to add a no pets clause. Can't do that. I'm a pet owner myself, but you should still have a right to tell what people do with the product that you're paying for and servicing and carrying. Saved up money for. Alberta is known to be as a landlord paradise. Here, it is the exact opposite. Damage deposit legal, illegal here. That's just in a comparison. And listen, I'm not knocking on Toronto. Toronto historically and traditionally is the magnet for international immigration. When people come and want to move to Canada from other countries, they either say Toronto, Vancouver, very few say Montreal, more of the French speakers, okay? But more people are starting to say Calgary, but traditionally it's Toronto as a destination point. And because of that, and because we're the economic powerhouse of the country with banking, et cetera, more people will come here, and then there'll be always a greater shortage of housing. But Calgary and Edmonton now are starting to do the same thing on a smaller scale. And that is why it's a great opportunity there. And like I said, think of them as 5 years behind us. So if we saw what happened here with our 5 years of growth from 2016 to 2021, really, or we can say 2015 to 2020 before COVID, that's what we can forecast is happening in Alberta. And that means because they're about a year to 2 into it, we can accurately predict what's going to happen in the future. That's how we make money. My new baby that I've been working on almost exclusively, because this is a limited time kind of thing, is a CMHC MLI program. It's a once in a lifetime multi-unit mortgage loan insurance product. Now, what is it? Everybody should know when it comes to investing in this great country of Canada, you must put 20% down to purchase an investment property. What the CMHC MIL program is, it allows you to purchase something with up to 95% financing. It can be 94%, it can be 93%, but it's usually anywhere around 95 to 93, somewhere there's the sweet spot. So with as little as 5% down, you can have decreased insurance premium, 10 years term mortgage, 50-year amortization, which basically allows us to have half the monthly payment guaranteeing that cash flow, okay? And an interest rate that's lower than the Bank of Canada because it's half a point above the bond rate. Now, this is all done with third-party cash flow sanity checks, which means you have multiple levels of people going through this to make sure the numbers are all accurate and the forecasts are right. So the CMHC Select Program offers reduced premiums, longer amortization periods for properties focused on affordability, accessibility, and climate sustainability. Pains me to say that, but the way I can justify it is you're using better quality products, which means you'll have less repairs in the future, less frequent repairs. Using a point-based system, the more you commit to these areas, the better the incentives, helping you improve the cash flow while supporting local and social environmental goals. Tired of negative cash flow with real estate investments? Listen, anybody that buys an investment property in Toronto is not cash flow positive. It just isn't. You're not in Manhattan. You're not in Toronto. You're not in the worst AAA cities around the world. But are slightly cash flow positive in Alberta because they're not there yet. They're a couple years away from breaking even in the negative. And then you just solely rely on capital appreciation. This is the opposite side of the real estate investment sphere. It is capital appreciation, of course, because we try to put you in the best areas, but it is cash flow positive because of this mortgage. So when it comes to the CMHC MIL program, what you're really doing is getting the best mortgage and the best terms you will ever get in your life as a Canadian. But we try to place you in areas to maximize your return. And it is only for projects 5 stories, 5 units and above in size. And we are focusing almost exclusively in Alberta because they're landlord friendly. And that's important. If you're like myself and you own multiple condo units in the city, you're not too concerned about your tenants getting together and all of them not paying you at the same time because they'll never find each other because you're spread out across the city in different buildings. But if you own a multi-res here in the GTA and one afternoon, all your tenants who constantly run into each other, what if they get together and all decide they're not going to pay rent for 6 months? Well, it'll take you 12 to 16 to kick them out. And by then you might be bankrupt. And that's why doing a program like this in parts of the country that are landlord friendly is essential. Next slide, please. And that's why we focus out there. So this is an example of an eightplex that I currently have. And what I'm going to do is I'm going to quickly show you something. So if we see here, okay, and let me get out my trusty calculator because it's almost my bedtime. Yes, I go to sleep that early. But what we have here is we see, okay, we see a pro forma. What a pro forma is a forecast about expenses and returns for some type of investment. This is your property, okay? And what we have here is we see that we're going to have 1-bedroom units at 1,700, 2 of them. This is an eightplex. 2 of them are affordable at 1,400 because 25% of this needs to be affordable housing. But still, because we put the units in the basement, we're almost at the same amount of rent, and it doesn't really affect our bottom line. And then our uppers are 3,000, which is 218,000 in rent a year. Once we go through all our expenses, we also get some garage rents. We cash flow before tax at 43,373. That's 43,373. Our down payment on this, because it's at 5%, which is what we try to get, okay, of a 3.350 purchase price is 167,500. That is a yearly return of 26%. So in Toronto, you're getting about 4%. maybe five, but really probably less. Okay. In Calgary, in the city, in a fantastic area. I know this area personally. Like I know Calgary, I'm there 8 times a year. Okay. You're generating a 26% return. You're doing that because of the price of the product is low. And you're also doing that because of this mortgage, but mostly because of this mortgage. So that's an example. If this interests you, we're going to talk about one more. Next slide. All we have here is we have an eightplex in Denton, Edmonton, Alberta. My friend purchased this. This was already built and nobody's lived there. So they just finished it last year and the developer decided to sell it about keeping it to buy up some more land because he locked in some more lots. And this one, we actually have our artificially lower rents and across all four basement units, so the return will be greater. And we have 42,000 as a rental return a year, 173. And the purchase price of this is only 2.4, again for an eightplex, almost similar. That's the difference in pricing between the two cities. Okay, and there's 120,000 down. That's a rental return of 35%. Imagine that. In 3 years, you've recouped your down payment. And these are market rents. Imagine that from a real estate venture. Same mortgage, 10 years. Term is set. Rate is set. Everything's set. In a province that's landlord friendly, you have the ability to raise rent every year. You don't like your tenant, they leave after a year. There's no negotiation. There's no talking. Sorry, I'm not renewing your lease. It's a 1-year lease. It does not extend. In the two of the fastest growing cities in the country. Next slide. Here's the QR code. Scan it. If you are interested in getting 20 to 30+% returns in two of the hottest markets in the country, in the most landlord-friendly province in the country, one of the most landlord-friendly regions of North America and the world, having the government essentially partner up with you, come to our info session next Thursday, January 30th, 7 p.m. in Mississauga at our Mississauga location. Call up your realtor, call up your friends, come listen to it. I'm telling you, that hour and a half that we're going to spend there, if you do not know about this, can change your life. I'm one of a few people that actually understands this product. I've been working this with a lot of my colleagues, so your realtor probably already knows about this, okay? Since last year, I was one of the first people in the province to be pitched this, one of the first people to bring clients to this, have been to these areas where we're building this. I was in Calgary in December and I toured lots, looked at stuff under construction, talked to mortgage brokers, talked to professionals, found, located, signed up some more of these. Trust me, if there's one real estate seminar you ever invest, and I'm not talking about those guys on TV that get paid to go and talk places and don't invest in what they're telling you to invest. I told you to invest in condos. They had 8.5 years of growth and a year and a half of a slight 10% drop. Okay, they've doubled in price in the past 7 years, literally doubled. Real estate in Canada doubles every 10 years. That's what it's been doing since the 80s, the price. Condos doubled almost twice as fast. What I told everyone to do investing condo-wise, I'm telling you, it's not for everybody. You need to have a substantial amount of capital to invest, anywhere from 120 to about 170. Now, because of the bond rate uncertainty, you might have to put 7.5, but we try to get you the 2.5 back. Just come. Take a couple hours, Thursday night in Mississauga, come to this seminar. You will not be disappointed. We had close to 80 people at our first one in October, and back by popular demand, we're doing an in-person one. If I am driving to Mississauga with my partners, and we are taking time away from our families to meet you in person. It's important. This is what you don't want to miss. The last time this opportunity was offered to Canadians was the 1960s. That is 60 years before today. The last time this type of mortgage opportunity was offered by the government, because it is insured by the government, allowing this to happen. If you're buying a house with 5%, you shouldn't be buying a house. You're buying the house with 5% down because the government is helping you by insuring your mortgage. Think of that with this. Guaranteed for you to make money because the government doesn't want anyone losing these properties. Next Thursday, 7 p.m., take the QR code. I'll see you there. That concludes our presentation for the evening. I would love to thank everybody from the bottom of our heart here at First Access Realty. For myself, my staff, and our agents, we would like to thank you taking the time from your busy lives to listen to me share a little bit of my insight with everyone.